Okay, great. Well, let me start off with a quick little intro, and then we'll go into Q&A. So yeah, we started off October red hot, up 1.1%. I'm sure we've all, you know what, let me go ahead and just mute the noise. If you do have specific questions, raise your hand, I'll unmute you just so we don't get the audio overlapping. So yeah, we started off October red hot, 1.1% return in the first few days, primarily from the TLT ETF. And I was expecting trade talks to break down. And then Friday, they came out and said trade talks were going great. And we had a phase one deal, at least at a handshake level. And that surprised the bond market and gold market. We had quite a sell-off. If I go scroll down to our returns on the TLT, you can see that we have a negative 2% loss in the TLT. Now the TLT is, again, our insurance policy. It has been our biggest returner this year. And as you can note, in the last 11 months, we've only had two losing months on the bond portfolio. And the bonds do its job. Whenever the stock market gets scared and sells off, the bonds rally. And in general, because we have 80% of all central banks lowering interest rates, we have the Fed doing repo madness that's getting oversubscribed, expectations of them to put around $500 billion into the banks as early as maybe this month, potentially next month. This sets us up to be long equities without having to worry about our bonds getting absolutely clobbered. So with the Fed expected to lower rates, with the Chinese continuing to back away from their trade deal, you know, they're already saying they want all tariffs removed. They want this Hong Kong bill denounced before they agree to any terms. So the bond portfolio will continue to play an important part in our strategy. And for the next few months, I do expect the equities to deliver our profits. So if I do go up to our slide, that's my Bootcamp Module 1. We'll take a sneak peek at that in a minute. This is our current allocation strategy, where you'd have 100 shares of the SPY, 200 in emerging markets, ETF, EM. And keep in mind, if things do flip and the trade deal does clearly break down, I suspect it will be most likely announced after the market closes. So you won't be able to quickly get out of equities. And we're most likely going to open up with a gap down in equities. And that's when we'd see our TLT and GDX pay off once again. So as far as the maximum drawdown on the TLT position, we're near that because we bought the 139 put. So there's very little downside risk between now and tomorrow on the TLT. And I believe that the bleeding is relatively over for the TLT. So we'll probably have a wide collar on the TLT once again tomorrow so that we can have the confidence to be long equities. Now our portfolio is overweighted in equities now, 48% with the equities position and 40% in bonds. Now, prior to this, we were underweighted in equities and overweighted in bonds and gold because of the Tuesday play having that silver position. So that's our setup currently. I think that there's going to be some pretty consistent returns on the SPY and the emerging markets as long as there's hope of a trade deal. The next supposed meeting between the two leaders would be November 15th. We have a very bullish catalyst coming at the end of October with the Fed most likely dropping rates 25 basis points. And now all the banks are being able to get out of these treasury positions. So think about it. If the banks who are having strong earnings this week can get rid of perhaps between $500 billion and $1 trillion of treasuries that have been bogging down their portfolios, they have a lot of fresh ammo to pile into U.S. equities. All we need is this trade deal to come to fruition. So, of course, there's plenty of uncertainties that doesn't allow us to be all in on one asset or the other. But that is my best explanation for those of you who have some losses this month. We started off red hot, 1.1% to start off October in the first week, only to see that mostly eradicated because of that TLT sell-off. But we're past that catalyst. We're potentially in a paradigm shift where the markets go long equities here. So I'm not worried about it and really like our setup going forward. So with that said, let's see if we have any immediate questions before I go into some of the content.
Hey, Jason, Scotty here. Can you hear me?
Yes, sir.
Hey, all right. Hey, so I haven't attended a live in, I count today as like 17 days since my membership, and so I haven't been able to attend a live. But this is a little bit of a testimonial. I've been like super busy, but I have been able to follow every trade to the letter all the way through. So SPY, TLT, and then all the Tuesday trades. So like I say, about 17 days in. My performance is matching the portfolio. So yeah, the TLT's been a drawdown since my official kind of kickoff becoming a member. I've got September 23rd as my start date. But I haven't been too worried because I know the long-term performance of the portfolio, and I'm tracking the same performance over the 17 days as you. So I know, hey, I've been in this thing a long time. I probably got the worst timing in the world, but I would happen to start right on the 17 days of drawdown. But like I say, I haven't been too worried because my performance is tracking right along the portfolio performance.
Okay, good. Well, that's great to hear, and that's the goal. That's why we designed this to A, be very easy to follow, and then B, to have the timing so easy to follow. So yeah, I'm not worried at all. My thought going into Friday was that Trump was going to blow up and raise tariffs. So think about it. If I were right and we had not played the portfolio the way we did, we could be sitting on a huge loss. If we had been all in on equities, predicting that if we predicted that Trump was going to sign a deal and we're completely long equities and that did not happen, we could be sitting on a 3, 4, 5% total loss in our portfolio very quickly from Friday through Monday. But on the other hand, I was wrong and we're sitting on a 0.5% loss and we played it safe. So clearly, I think you've seen me do this from time to time. The last time I was playing it safe, predicting Trump would lose his temper, was in July. So we did lose 1% in July. If you remember in June, for those of you who have been following me that far back, I was saying, oh man, Trump is running out of time to raise the tariffs. He's got his election coming up. He's made no progress with the trade war. I'm suspecting that he is going to raise tariffs. And they went to that Japan meeting and for the G20 and came out saying, oh, we're going to have a great trade deal. And then what happened? 3-4 months later, no trade deal. So again, we suspected the same outcome on Friday, and it didn't play out. So we got a sell-off in the TLT, and that's why we're down. But now that perhaps this clarity is in our view that the equities can rally, that the Fed is lowering rates, printing money aggressively, I think we're going to see very consistent returns on the Monday and Tuesday portfolio and slowly bleed in our bond and metals portfolio. But again, that is the strategy. We don't expect all of the assets to win all of the time. And all we need is, another Trump tweet. If this trade deal breaks down between now and November 15th, those TLTs will pop right back up to where they were. So certainly not worried about it. And I really like our setup here. So thanks for that comment, Scott. I really appreciate it. I know a lot of people who just joined, specifically, I believe Jerry Gettings on the webinar today is in that boat. He jumped in, he'd seen our, red hot track record and got hit with a string of losses. So Certainly, I hope people can look at our longevity of our track record. Keep in mind our return in December when stocks fell 10%, we made 1.2. In May, when stocks crashed 5%, we pulled off 2.2. And really, the only time we've lost is when I was playing it overly safe. So in July, I was predicting a rise in tariffs. It came in August. Now, notice when the tariffs do hit and the bad news does hit, our portfolio does very well. So in August, when the tariffs did hit, we had a nice return of 1.8. And also, if you look at the return of the S&P 500 from August through current, we're down about 1%, but our portfolio is up 1.6. So in the grand scheme of things, sure, we had a little drawdown, but I wouldn't change the way we played it. You know, looking back, if anything, I might have bought some more expensive puts on our TLT and still kept that call option way above. So if we did have bad news come out Friday, we wouldn't be shortchanged on the TLT.
Hey, Jason, another thing that in these past couple of weeks that I've really liked about your whole system is just how easy it is to execute. I've been like super busy calling on customers, traveling with my boss. I actually had last Wednesday, the SPY trade came out and we were standing in line together right before lunch and the alert came over and pretty soon, I mean, or pretty quickly, you get to anticipate what you're going to do. I actually like to guess, you know, it's going to be a call and a put number. And I kind of like to guess, okay, is he going to go 302? Is he going to be a little bit conservative and just go 301? And I literally just said, excuse me, you know, and walked off to the side. I'm not as fast as Dean yet. It probably took me 2 minutes. But put on the, you know, came off and put on the trade. And I'm just like, I just love how simple this is. And then if I can't catch the call, you know, it's always there at night. I can listen to YouTube and catch the update, which I do. So this is just, you know, of all the other options, and you and I have talked before, I've been a subscriber junkie to so many other programs. This is just so easy to follow. I even went back and listened to some old Tasty Trade Rising Star videos just to kind of get back up on options a little bit. And they recommend that you keep 20 positions on at any given time, so that you can get the occurrences. It's all about number of occurrences there. And I'm like, how in the world would I actively manage 20 positions at a given time? There's no way.
Oh man. Well, realize your SPY is 504 positions.
Right.
People don't realize that, I think. And the emerging market fund is actually over 1,000 positions. We do have a question from Ernest. Let me pull up that. So this is the latest update. Essentially, here's what's changed. Prior, we had a 3-to-1 ratio on the TLT to SPY, as we were in a more defensive stance, skeptical that a trade deal would be accomplished. And so I like to wait till after the fact. So the fact was, before Friday, we had a 2-year history of trade deals breaking down. So you'll see, I will always play the safe prediction, and the risk is we miss out on potential jumps in equity prices primarily. So the change was to get out of silver on the Tuesday play, which would benefit from QE, which we have. It would benefit from lowered interest rates, which is projected and happening in 80% of all central banks. But the last ingredient for silver and gold is you need shock and awe and some sort of crisis. So now that the major crisis point has at least been delayed, which is the trade deal breaking down, we want to be long emerging markets for about a 3-to-1 ratio. So we have 3 times, we have $30,000 in the SPY versus around $9,000 in emerging markets at that ratio. So Ernest, you should have audio now. Do you want to check your audio?
Yeah, I got it. That's fine.
Okay, great. So yeah, the profits, as long as this trade deal doesn't break down, should primarily be from our Monday, Wednesday, Friday SPY trade and the Tuesday emerging market trade. And I do suspect some bleeding in the TLT and GDX until the next shock and awe moment comes. But we have all the right ingredients for bonds to go higher and gold. You know, we have this conflict with China that has very, very little chance of being resolved for the big picture. Sure, can they maybe get this phase one done? I've been saying I thought they could get it done for quite some time. But we continue to see both sides, you know, throw in little extras they want to close it. Meanwhile, gold has two of the key things we need: lower interest rates and QE. So now all gold needs is another little scare in the markets. Let me just pull up some of the stuff I've been putting together for the boot camp, just to give you guys a little bit of a sneak peek at it. A lot of you guys are actually in the boot camp, so I can't wait to get that started, coming up in several weeks. So again, we're not going to be able to accomplish an unlimited amount of things in a 16-week boot camp, but what I do want to do is try to get you guys in tune with what I do on a day-to-day basis as possible. So what it will have is not only these modules every week, it's also going to have a daily data dump of articles, videos, a YouTube playlist I'm going to build, so you can just plug in the playlist and listen to all the videos I've listened to over the past 24 hours, as well as all the articles I've read. And so what's going to be important is not just learning, you know, which news sources I am tracking, but what am I filtering out of that? Because there's just way too much content coming in. So you'll be able to see which sources do I listen to, what am I filtering out of it, and then be able to jump in and study those materials when you have time. I know a lot of you guys don't have time for all of that, but I'll just do a quick, well, real quickly, let's see is there any other questions out there before I jump into any other materials?
Hey, Jason, it's Karen.
Hey, Karen, how's it going?
It's going. Just been a little busy myself. I'm up in Tennessee right now. So I was trying to listen to something because you listen to or you read up on Jeffrey Gundlach too, don't you?
Sure. Yeah, I do follow Jeffrey Gundlach.
Okay, well, I tapped into a webinar that I was able to get into today, and I missed like 2/3 of it. But if I can get a recording of it, he had an amazing amount of charts and etc. So if I can get my hands on it, I'll forward it to you. It was pretty interesting at the last third of it.
Oh yeah, I love following Jeffrey Gundlach. So
yeah,
you know, he was really accurate for 2017, 2018, 2019. He's been very inaccurate.
Right. Well, what he was doing is, and I heard part of that, he was comparing what he did in 2005 and 6 on the early side before everything else happened in 2007, 2008, 2009. And he's comparing it. So the only thing I heard towards the end of this was about his focus on, you know, when people said, their question was asked, you know, what do we get defensive now? And what do we do? And he said, well, let's go into US Treasuries. And then he talked about gold. And he said it is definitely part of his portfolio. He did say he felt gold it was going to go back down towards 1,400, and then it's a definite buy. You know, and he says, and so what if you're a year or so early? Better to do that than the alternative. That was his comment. Wealth preservation, which is of course right up your alley. What else did he say? Stock market. Oh yeah, he's focusing a lot on the stock market outside the U.S. in their currency. He kept saying. So I thought, okay, I want to raise that too, Jason.
Sure. So the 4 guys I like to track the most are Ray Dalio, Jeffrey Gundlach, Stanley Druckenmiller, and Warren Buffett. And
right.
Did anybody notice that every single one of Warren Buffett's core positions are at all-time highs recently? Apple, Bank of America, JP Morgan. The guy is just a rock star.
How convenient.
Right, and he just requested approval to go over 10% total ownership in Bank of America.
And the last thing that I picked up on was that he talked about non-US ETFs, which was interesting. So I didn't get to hear the whole thing, but I'll see if I can find, or get a copy of because he had a ton of spreadsheets and he was zipping through, and a lot of them are like what you're looking at. So I'm going to see what I can find. And I'll
Sure.
try
So this specific setup right here is extremely close to Stanley Druckenmiller's portfolio. So his biggest position is Microsoft, which is the biggest position in the SPY. And that is a huge chunk of his total assets is just Microsoft, which is also, of course, at the high. He has about 10% of his portfolio in emerging markets companies, a lot of it in EEM, but also kind of handpicked companies like Alibaba, JD. But these same ratios. Now, he was also the one back in December telling everybody to go long TLT as well. So he's been extremely accurate this year. Buffett, of course, all of his top assets are at the high, so he's doing very well. Ray Dalio has been creamed this year. He was long emerging markets and short the dollar and the TLT, so all of those went against him. He's just managing such a gigantic fund, $120 billion, that he has to be early, so he may turn out all right from that front. Jeffrey Gundlach was pretty much the same, short the TLT, long emerging markets. He was throwing out like a bonus trade to go long Bitcoin back last December. But other than that, he's had a tough year with his calls. His big concern is the increasing deficit and supply of treasuries. So he thinks that TLT is going to blow up at some point. But yeah, I carefully follow those four in particular for long-term predictions for sure. Any other questions out there? I wanted to kind of sneak peek a little bit of our bootcamp content that I've been working on. But first, let's see if there's any other questions. Okay, any other questions? I do have most people muted right now. Just if you want to raise your hand, I can unmute you to speak. Otherwise, I think we all have a pretty good idea of the strategy. So we have the right. Anybody have questions on this asset allocation? So this is extremely close to Stanley Druckenmiller's exact portfolio. So I look at his quarterly filings. I would bet after the phase one trade deal was rumored, he went heavier in emerging markets, and potentially could have been the one causing the sell-off in the TLT, as he's been hyping that since last December, and I think he's up almost 30% on that. He's averaged 30% a year for some 3 decades, just absolutely phenomenal. But yeah, so his portfolio is extremely correlated to what we have up here. Okay, let me jump into some of the bootcamp content. And part of actually, let me pull up one item. Now for our bootcamp folks, one of our trades we are dying to get into, but held off on, thank goodness, was to short the Chinese currency, which is CNH. So we're going to be selling a futures contract. That just means we're going to sell their currency at today's price and then buy it in the future at a discounted rate, if we're correct, if they devalue their currency. And so I was waiting for the next catalyst to push this conversion rate higher. The bottom line is every 10 cents this travels higher, the future contract will have $1,000 profit. Now they did pull that back considerably on this trade deal Friday, but it has since then popped up again a little bit. And so part of the phase one trade deal was going to be some sort of agreement. Everything about this phase one trade deal is very ambiguous, but part of it was going to be something to do with fixing or pegging down their exchange rates so that they cannot offset tariffs, which essentially, I think they just want to say, all right, if you guys steal IP, we're going to levy these tariffs on almost on an automatic system is what they've been talking about. And so it's a good thing we paused on that trade. We'll know closer towards November 15th if we want to put on that trade. The problem is the US wants China to stop subsidizing key industries that they want to take over, but that is their competitive advantage in the world. So I just don't see that happening. Now, as far as buying some agricultural products to delay tariffs, that's something I thought would potentially be on the table, and maybe even easing some of the sanctions on Huawei. And so that's what I've been saying was potentially a deal that could be reached this year. And if so, we want to be long emerging markets and US equities. So that's the deal. They almost exactly, they didn't talk about Huawei, but pretty much that's exactly what was announced Friday. And then come Monday morning, China's not talking about the agricultural products. And now they're saying they want all the tariffs removed that have been put in place to date. Now, if they did remove all those tariffs, we could probably go back down significantly lower on the currency. So it's just a guessing game as to what Trump's going to do or not do at this point. So we're still waiting to pull the trigger on that futures trade. But once we get the threat of new tariffs, we've seen the Chinese have a pretty standard protocol. And you can actually look at the timeline and go back. This is just 1 year on their currency. But they do it swift. The second they see the tariff threat, they want to ease the concerns of all these companies in China. They immediately devalue their currency to offset that tariff, at least to a certain degree. Now, we have seen the PPI drop in China, and that does show that their companies are having to lower prices on top of these, the devaluation of the currency to try to keep the prices similar for the Americans after they have to pay the tariff tax. So this is my favorite dead obvious trade once we get the catalyst. The catalyst will be China is backing away from the deal that they just promised. We're going to go ahead with the December 15th tariffs. And if they don't do that, it's going to go up even more. And I suspect by January or February, he's going to have to start really aggressively raising these tariffs to close the deal. So that is one outcome that I can see very likely, and we want to be ready to short CNH once we get that. Now, the market has been trying to predict that and edge that currency up, as you can see. So we'll probably miss out on some of the gains once we have that dead obvious of a trade in our lap, but the risk will be much lower than jumping in it right now. Now, on the other hand, if we can get them to buy some agricultural products, I think they do need to do that. I think they're having a hard time buying agricultural products from places like Brazil, who just don't have the infrastructure and organization to pull off, they went from $20 billion a year in agricultural product purchases down to something like $7 billion this year. Now it's picking back up. So that's what I'm suspecting. I think they can come to some terms. It's in both parties' favor. Trump wants to win the election. He's not going to do that if we're in a global recession and then headed towards a depression. China desperately needs access to capital to keep its bubble expanding. So I think that potentially phase one can be accomplished this year, or maybe pushed into sometime in January or February at the latest. But I think phase two will be where we get friction again. So that's going to be getting really close to the election period. So it's going to be very, very fun to watch all the fireworks as we get closer to the election. All right, let me go. So any questions on the currency trade? Okay, great. Let's take a look at some of the content we have coming up for the boot camp, and then we'll wrap it up. As far as what I expect for the trades rest of the week, Thursday, we're going to have to continue to have a relatively wide collar on the TLT, because again, it is our protection. It's our insurance policy in case the trade talks break down. Outside of that, I think the TLT has limited downside risk because we got the Fed just massively buying up these treasuries. The banks want to get out for a nice profit, and I think they will load up into equities as long as we don't have the trade friction. Bank earnings are coming out strong. 85% of the earnings we've had so far are beating expectations, and that's only about 15% of the companies, but everything's looking very good on the US equity standpoint. And emerging markets, again, is down 20% from just the 2017 high. So there could be the potential for a better return in emerging markets than the SPY. So on a good trade deal, I'd suspect the SPY could go up probably to the 315 to 330 range. So about a 5 to 10% potential return on the SPY, whereas emerging markets has potential to get at least to its 2017 high for a potential 20% return. Okay. Meanwhile, trade talks break down. China doesn't want a deal. They want Trump out. That's certainly a potential threat. So here's a look at some of the bootcamp content. This is the module 1, where we're going to be talking big picture. It's not done yet. I just want to show you guys some of the content I've put together. So again, this is all revolving around trying to have a very simplified portfolio where we're primarily just playing US equities, emerging markets, the US Treasury market, and then either betting up or down on gold, which you'll see tends to either fly up or fly down, doesn't usually stay in one place very long. Most important thing is clearly whether the Fed is buying or selling treasuries. Every time they try to sell treasuries, we have problems. Think of 2018 when they tried to sell treasuries. 98% of all assets lost value. It was horrendous. And right now they're buying. 2, is the Fed raising or lowering rates? They don't always do these in tandem, but currently they're not only buying up treasuries, they're also lowering rates. And then number 3, the most important thing to track, which dictates what they will do with both of the last 2 measures, is inflation. In fact, that's really the only thing that stops these bubbles in the long run, is when we get bouts of inflation. This is our risk-on strategy, where we have a slightly overweight equities portfolio, but the bonds are there to save the day. If we get a risk-off strategy because the trade deal breaks down, most likely we will rotate to a heavier gold and silver position, and that's because we have all of the things we need for precious metals to thrive. We have, number 1, lowered rates that are going down. 2, we have the Treasury, the Fed buying treasuries. And then number 3, we need the fear. So most likely we will rotate out of emerging markets if the trade deal breaks down, and then add in some extra exposure to precious metals with silver. Here is a chart of the SPY with the TLT, and it's kind of hard to see in this example, but if you look at the orange line down below, and you can see the change in value, this correlation breaks down a few times in history, but in general, when equities sell off rapidly, the TLT will have a rise in value, a significant rise in value that can offset much of the losses in the equities. Now, there's a case where, because we have a put option, the equities can lose, say, $1, but our TLT will only gain $1. But because we have 2-to-1 ratio of the TLT against the SPY, we can actually come out with a profit when we have these surprise shocks. So if the put option kicks in and the TLT can create more of a profit than we've suddenly lost from a surprise shock in equities, that's the main strategy. And you can see anytime there's a significant drop in the top line, the TLT bounces significantly. And in general, they're both moving up together, at least in this period of time. Here's the emerging market fund. We'll take a look at what's underneath the hood of emerging markets. But you've got all the big billionaire hedge funds are all about this ETF and are predicting over the long run that it should start to outperform the US, primarily because of our problem with debt. So whenever we think the markets will travel higher, we're playing this on the Tuesday play, at least if we think emerging markets can travel higher. Here's a look at the TLT all on its own. And again, relatively a dud most of the time, but it kicks in whenever equities sell off. And you can see those rapid rises in value. And that's the big strategy here, is that when we get the unexpected surprises, our put options reduce the losses on equities, and then the bonds come in and generate the profit. That's also why you can note in our track record, we do surprisingly well when equities sell off because of that core TLT position. The basic guidelines for buying gold is you want, number one, the Fed to be buying treasuries, which they are currently, and that's probably why we've had a nice rally in gold this year, is because participants were predicting this would happen. And we also want rates to be dropping, which is also happening. Now, when those two things stop happening, look out below on gold. You can see just how volatile it's been. So we can play gold in both directions depending on where we're at in the cycle. Here's a look at the gold GLD ETF, which we played for most of the year. Now, GLD is not back to those 2012 levels, and I'm suspecting it will travel significantly higher in the next several years just because of how bad the problem has become around the world with $16 trillion in negative debt that has to get replaced. So the balance sheets of all these banks is going to grow dramatically in the next year or two and free up these banks to not be stuck in these bonds that lose money. And you can also see there's a different correlation. Once again, we have the TLT below. So the main goal is to have these different assets overlap and not be overly correlated, so that when one loses, the others are typically gaining. And that's how we're able to achieve a very strong return with very little drawdown. Now, if gold prices get expensive, that's when I like to rotate into miners. So with our buy and hold position, we're in GDX instead of GLD, but we did play GLD for most of the year. So we just recently switched into GDX. And again, we got the two core ingredients that we need, which is the Fed's lowering rates and buying treasuries. The last ingredient will be fear. Quick look at the SPY ETF. It has grown substantially in size to $262 billion in assets. Absolutely insane. It's extremely diversified with a heavy tilt in tech and finance. Here's a look at the top positions we have. So like I said, Stanley Druckenmiller's biggest positions are Microsoft and Amazon. Meanwhile, Warren Buffett's largest positions are Apple, JP Morgan, and no surprise they are in the top of the SPY. This gives you a feel for the profitability of these companies. At the top, net incomes in the tens of billions of dollars. So Microsoft, 39 billion, Apple, 55 billion, Amazon, 12 billion, Google with 34 billion. And in a minute, we're going to compare this to emerging markets top companies. Facebook at 17 billion net income, Bank of America 29 billion. So all of these are in the double-digit billion dollars. And it's just remarkable how many companies are in the S&P 500. And I think a big mistake a lot of people do is they end up owning a huge position in a company that shouldn't be that large. So, you know, even in the S&P 500 SPY index, Microsoft's only 4%. And Stanley Druckenmiller's, it's 20%. So if you have a big position in some company that the SPY has, say, a 0.5% position in, you got to think about, was that really a smart decision? Even once we get to the bottom of this list, these companies still have billions in revenue, despite being so low on the totem pole. I mean, Goldman Sachs only has a 0.26% position. Here's the emerging markets ETF. It has $25 billion in assets, so it's about 1/10 the assets under management as the SPY. It has 1,059 companies in it. The main sectors are China and Hong Kong, so about 30% is going into Hong Kong, or rather China, but it also has exposure to South Korea, Taiwan, India, Brazil, South Africa, Russia. So it's a very diverse basket. Biggest positions, Alibaba, Tencent. Guess what the biggest two foreign positions are for Druckenmiller? You got it, those two right there. Got Samsung. We got a lot of companies, but similar net incomes, not as large as the American companies by and far, but they are just now starting to rip off all the American companies and get their feet on the ground. And they have a much larger audience, potential audience in Asia, 4 billion people out there to serve. So that's why these big hedge funds want to get their hands on these companies. And so we're not going to be analyzing these to that degree because we're letting the ETF do that work for us. But I just want to point out the sheer size and profitability of the companies that our ETFs do hold for us. Here's a look at some of the companies in the emerging market ETF as we go down the line. And again, just shows you how diversified your portfolio is, even though you're only having to worry about 4 ETFs. By owning the SPY, you have 504 companies. By owning emerging markets, you have 1,000. So you have a portfolio of equities that's diversified into 1,500 companies. Now here's a look at the GLD. So that's a spot gold. Right now we're not playing spot gold. We're playing the miners because we already have elevated price gold. Here's GDX. Now if we compare the assets under management, these are two different companies, so competing with one another, but $16 billion is currently in the gold trust. Now a lot of people just buy gold outright. But the gold miners, once we look at their balance sheets, you'll see why, particularly if you have some small cap gold companies in your portfolio, you might really think twice about that. So GDX has $11 billion in assets currently. Most of the mining's happening in Canada. The biggest companies are Newmont and Barrick Gold. Druckenmiller is all in on Barrick Gold in terms of his gold position. BlackRock, the biggest wealth manager in the world, and JP Morgan, most of the big banks are primarily loaded up in that Newmont. So you can see 22% of our gold positions concentrate in those two companies. And after that, it really drops off very quickly. I want to point out that these gold companies were losing a lot of money and in dire straits before all this, before the Fed started lowering rates, printing money, and the trade talks created fear in the markets. So you can see these companies by and far have unprofitable companies as of their most recent earnings reports. Very few have a profit. So if you are picking up small cap gold companies, most likely they are going to take every penny they can raise and just buy investor relation ads to raise more money, and probably won't actually be mining gold or creating profits. Now, one guy I like to listen to, I think his YouTube channel is Main Street for Wall Street. I listen to a handful of people just for negative news. So I'll listen to CNN. Every day I'll listen to Fox Business, CNBC, trying to get a variety of angles. So I'll listen to Chinese media and Russian media. And then this will give you quite an array of different ideas. But just funny enough, this guy on Main Street for Wall Street has quite a following on YouTube. Completely negative news. But he's all about this Sandstorm Golds. I don't know if he has some sort of deal with them, but he's trying to get people to pretty much load up on Sandstorm Gold. But the big money that's managing billions of dollars has less than 0.5% of their portfolio in Sandstorm Gold. So definitely much smarter to just buy GDX and let them build your portfolio for you with a smarter index strategy. This guy's out here getting people to go all in on Sandstorm, and it's a tiny, tiny company that's barely had small amounts of profits. Now, same idea with silver. Silver is supposedly at a 26-year discrepancy in terms of the price ratio of gold to silver. So everyone's suspecting silver's price ratio will catch up at some point. The companies who mine silver are a lot different than gold. We're still waiting for that spot silver to jump before I would put us into SIL, but I just wanted to review that. So this silver trust does have quite a large net assets of 6.7 billion. And here's the companies. The only real overlap is this Wheaton Precious Metals is both a gold and silver miner. But you can see the top two positions in SIL are different than that of the gold miners. So we're probably a little ways off playing SIL. And again, just be careful. These companies can lose money very rapidly. And I'll be just as happy to short gold as I am to go long it when the time comes. And if we go back to this, you can see the prices in gold tend to move very rapidly depending on what the central banks are doing. Okay, let's see. I'll go a little longer into some of these various periods. The next part of the presentation is going to primarily focus on looking at events in history where either the TLT was able to support the SPY when it had sell-offs and or when both broke down, and what caused the strategy to break down. And primarily, the answer is when we have rising inflation, this can be problematic for both the bond market, really for everything. And so what's funny about that is they slowly but surely adjust the way they measure inflation so that they can be more accommodative to the economy. And so this is the current breakdown of the CPI. We can see clearly we're stuck in this band that's headed towards zero. And that's my expectation for the foreseeable year or two, is that the banks they'll do what they can do. They can lower rates to zero and they can print a whole lot of money. until inflation starts to perk its head up. Now, are we seeing much inflation around the world? Not really. China's got a high CPI print, but if you strip out the food index, it's not 3%, it's 1%. So they're actually dealing with the opposite problem, except for food, which also makes me think they're going to be highly motivated to buy agricultural products at some point this year. And maybe they'll just try to sneak out a few extra items on the deal to give themselves some more time. But the big picture is that you print too much money, eventually you get inflation, and eventually the central banks have no choice but to ramp up rates. And so there's been several times in history where it perks up, and the bulk of this presentation will get into when we've had shocks of inflation, what was happening, and how we would have to react. Now, the bottom line is, if I go back to this setup, we won't have to change our assets. We'll just have to change the option contract. So instead of selling the out-of-the-money call option and buying the out-of-the-money put option, we'll be selling the in-the-money call option and buying the in-the-money put option. And so that allows the asset to finance the whole operation and give us a relatively risk-free way to bet down on these different assets.
Hey, Jason, that's the upside down collar, isn't it?
Yes, sir.
Would you repeat that?
Yeah, you want me to pull up an example of when we've used it?
Yeah.
Sure. So we've used it very reluctantly because we don't have inflation. And so we've only used it for very short periods of time. The most recent time we used it was on the TLT during this period. So the TLT fell, I think we went short the TLT with the collar, so we're not actually like about right here. And it kept going up. I was very worried, but by the next Thursday, it started to drop. And then this is when, this sell-off in the TLT is when we got the Fed to come in and say, oh, we're gonna start up QE in the near future. So we got the Fed put. But yeah, let's pull up some of these trades. Okay, so here's a good prime example. Is that easy to see, or is that kind of small?
Yeah.
Okay, so here's the key things to track. As always, first thing we want to do is when we enter the trade is keep track of the price of the asset. So at this point it was 146.38. Now, to generate a safe profit from a downward move, we have to buy the asset, sell an in-the-money call, and then buy an in-the-money put. Now, this is a lot different than buying a put option on the TLT. So if we buy a put option on the TLT and it goes up or flat, we could lose most likely 80 to 100% of the value of that put option. So you're going to have to play with a very small amount of money, and it's going to be an extremely high-risk trade. If we do this strategy, it's a much different risk profile. So as you can see, going into this trade, we had quite a bit of risk to the upside. We could have lost $2.87 a share, which was very aggressive. On the other hand, this will not accurately calculate our maximum profit to the downside. Talk about why. But if we were to hold this position to the close, instead of closing it out with some time premium, our maximum profit on this would have been $1.13 at the expiration date. And so let's just talk about what we did. So it's trading at 146.38. We sold the 145.50 call for $1.68 credit. So we can see we're agreeing to a loss of 88 cents on the underlying asset should the option buyer exercise his right, which is okay because we collected $1.68. So we'd be on that part of the trade, we wouldn't care. We're not going to lose money if we are assigned. Now, what did we do with the $1.68? We turned around and bought a very valuable 149.50 put. So just note that the call option we sold is below the trading price and the put option we bought is above.
Yeah.
And so this is the setup to safely generate returns to the downside. So at some point, here's what I think will happen is I think the Fed will drop rates significantly. I think eventually the trade deal will break down. I believe the central banks will have to pump a lot of money, not just US. I think this will be a worldwide phenomenon, is that all the central banks are going to be trying to do QE at the same time. So eventually we will get that inflation, and that's when we have to hike the rates up. So there will probably be a period of time. Let me pull this up. This is what we all need to be worried about, is the Dow during this period. So immediately going into the Cold War really didn't cause problems. It caused us to print a lot of money. And it wasn't until inflation came in that we really had trouble. So we can see the Dow had a bear market that lasted 15 years. That's the big thing we need to worry about. And it's not like it was straight down, but the overall trend was primarily to the downside. And that was for 15 years. Now, what I want to look at is what did the rates do during that period? Let me zoom in on this. So we would be doing these upside down collars if we thought the Fed was going to have to raise interest rates. So Paul Volcker was the chairman for this entire period of time. And what did he do? He jacked up rates all the way to 20%. Now, it's not like it just went straight up. He lowered it and raised it and lowered it and raised it. And that's one nice thing about these bankers. They tend to do a decent job at forecasting what they'll do in terms of the rates, which gives us the knowledge we need to get the big picture right. So what happened to inflation during this period? You can see there was a little bit of inflation in 1947, and they got that under control, spiking rates. It was relatively low inflation for all of the 40s, 50s, 60s, and then suddenly inflation got out of control. And from the 66 period all the way through 81, inflation was over 3%, as high as 13%. And so that's the period where your bonds fell apart and your stocks fell apart. So again, we wouldn't change which assets we're holding. We would simply go use this setup. Now, we can tweak this a little bit to actually increase the profits even more. But here's what's neat about this setup. If we enter into this position, say tomorrow, and then the TLT were to go against us and spike much higher in the next day or two, the potential is we can get assigned. So we go out of the TLT into cash. We get the price we sold our call at. We get to keep the credit, but then we're still long our put option. So the potential for this setup is we actually get assigned, get the maximum profit out of the call option. That's possible. And then we don't have to worry about a downward move in the TLT, and we still have our put option, which was primarily financed from the call option we sold. So we can actually end up in a scenario where we get a much larger profit than this risk graph would indicate. Also, because we're closing these out with time premium left, in the case that the TLT does travel lower, that implied volatility goes up and it makes the relative value of the put option go up significantly. So we actually have seen a bigger profit than the risk graph. Let's just see what we got on this one. So you can see this risk graph calculated a maximum profit of $1.13, and we had $1.27, and that's because the implied volatility had spiked up. Now, if you had sold it earlier, like Kirk had done, which we've shown in some webinars, the implied volatility was much higher. I think he got like $1.80 or something by pulling this off earlier than we had. So that will be how we profit from a down move safely. We have a limited risk in both directions, and so the time will come. Most likely, the central banks will do what's in their power, which is lower rates, print money, and wait for that CPI to pop up. And it can come out of nowhere. So let's take a look at. Here's that inflation print. So it was nice and steady and controlled for decades, and then boom.
Well, it's really, really simple to enter. It's still selling the call, buying the put. It's just the amount. The upside down piece of it is just the part that's in the money.
Yeah,
and it's
so from
working.
your standpoint,
Yeah.
your daily work won't change.
Yeah.
But just with that small change, it can dramatically change the results.
Puts it in a bearish position.
So if you listen to Ray Dalio, his prediction is that we are headed for exactly this. That we're in he says we're in the 7th inning, and the banks have a little of ammunition left. Usually, let me go to more recent. Here's the kind of my lifetime in investing, what we've seen. So typically, to avoid a recession or to get out of a recession, you can see they've been pretty good at predicting a recession before it happens. They start to drop the rates. But in the past, they've waited to do QE until after we've had like a 40 to 50% crash in equity prices. And it's only after the QE came in that assets did rebound. Now, this time around, they're not predicting a US recession. They're worried about a global recession. And so US equities are at all-time highs. Sure, that's similar to the 08 crisis and the 2000 crisis. But they're doing QE as an insurance policy. So this time around is quite different. And I think they realize, if you look at the change of interest rates, it was about 5% of a drop to get out of the last 2 recessions. They can't drop 5% this time. So that perhaps is why they're aggressively doing QE right now. So I think we're all going to be a little bit surprised about just how much QE is headed towards the banks in the next 12 months. And that could be very bullish for equities, especially if we get this phase 1 deal. But yeah, here's been our CPI prints over the last 20 years. So, they started to heat up in 08. They jacked the rates up leading into that, and we got a crash. Started to heat up again for the, that's not showing us the dot-com bubble. Here's the dot-com bubble. So once again, those interest rates started to perk up, or rather the CPI, the inflation rate started to get hot, 98, 99, 2000. They had to jack up the rates and we get a crash. So pretty much every time that they raise rates, you can predict what will happen. Now, the exact timing can be, it's not happening immediately, but these are the core things to study. And now we have Powell. So, December, he was telling everybody rate hikes are on autopilot, quantitative tightening is going to be like watching paint dry. And they quickly reverse that course. And so you can see there they are trying to jack up those rates so they could have some ammunition for a future recession. And that didn't last very long. And we had the 2018 Christmas massacre, and immediately they reversed course to dropping rates. And if I go back to the first slide, we're back to QE. So how much will they expand the balance sheet this time around? All right, guys, well, we ran for about an hour. There's a lot more content in this. Maybe in the next webinar meeting, we can tease it some more and jump into what we're going to primarily study in this module 1 are the crises over the last 100 years. We've only looked at a handful of them briefly in today's presentation, but we're going to look at every single time the stock market has had a severe crash. What did the bond market do? And what were inflation rates and Fed policy during that time? And essentially, we're going to learn how that just simply alters our options to profit from the same basket of equities. And so really, the only things will really change ever in our strategy is the SPY and the TLT will, at least until a major financial crisis has occurred, will remain intact. The Tuesday play can rotate. So we've played Apple for quite some time this year and did very well. And that's when the pressure was on top of China. At this point, it looks like there will be a lot of relief for China. So that's why I like emerging markets at this point. But put the pressure back on China, and I suspect silver will be a better play. Any last questions before I let you guys go for today?
Jason, thank
yeah.
you.
Oh, sorry.
Go ahead.
I do, Jason. And I'm sorry, I've had several interruptions here. You may have said something about it. If you have, just let me know and I'll go listen to the replay. I saw something yesterday from the IMF about them re-projecting GDP in the global markets. And so it was interesting to me because you had put the EEM trade on, and they're reducing not just here in the US, but pretty much everywhere across the board. So did you happen to see that, and did that influence your decision to use the EEM, or does it really have no significance?
I did watch that. Yeah, they recalculated the global GDP down to 3% from like 3.1. And yeah, so we want to buy, we want to jump in when there's the problems and there's a discounted price. So emerging markets are down 20% because of this exact problem. So yeah, that's definitely a core reason. But yeah, the main reason why is it looks like there's going to be relief for China, and it's been significantly sold off. Now, I'm aware of, obviously, we spend half our time dogging on China and talking about how much trouble they're in. So for sure, definitely on top of that news flow.
Okay. Yeah, I'm bracing myself for the Hong Kong thing, but with the EM, just
the big picture is we're in a period of quantitative easing. So this is going to be very bullish for equities. And I think the only thing that could get it off track would be either inflation or a massive breakdown in trading, which could happen. So far, inflation, at least the way they measure it. Let me pull up this one chart. This is almost comical. Here's the scary thing. Is how they measure inflation. Let me pull up some of my
Oh, I
chart.
know. I mean, you know, exactly. Their inflation measurements don't even correlate really that well with with what is real out there anymore. I've been watching that for years. It just doesn't make any sense.
Yeah, so all of the sectors the government has come in and supported and bailed out have been inflating in price rapidly. So primarily the housing market, think of the '08 bailout, Medicare, continue to bail out that sector, and then college education, just I think it's up some 1,000%. And that's because the government told the banks will guarantee all the student loans. So the colleges went and immediately increased prices tenfold over the last, I think, 10, 20 years.
Right, and dumped it all on the taxpayer. Thank you very much to the previous administration. Don't even get me started on that one.
Right. But, you know, from the other standpoint, the world's become much more productive. We've got Amazons, we've got fracking. So there's a lot of downward pressure on inflation. Every time so here's the CPI versus the effective federal fund rate. And so you can see every time that blue line starts to jump up, the red line is forced. So the blue line is inflation based on how they measure it, CPI. The red line is the effective federal funds rate. And so they pretty much just try to keep that effective federal fund rate a little bit above inflation. Every time the inflation starts to perk up, they'll go way above it to suppress it down quickly. And every time they do that, we get a negative GDP print and we get a stock crash. And so simply tracking that inflation really dictates all of the markets. Now, here's some of, here's one chart this is based on 1990 CPI formula. So if this is really a more accurate picture of what the inflation rate is based on the 1990 formula, the federal funds rate is way too low. If we go back to the 1980, it's even worse. And then, you know, you think, oh, we got great, you know, record unemployment, that's great. But, you know, what happens when everybody has more money? It puts more pressure on prices. And so, yeah, I think at some point the world will be shocked. We get a wave of inflation, and that's when your long bond, long stock strategy really breaks down. Now, for us, it won't be the end of the world. It'll be actually a more profitable period because we can put on these trades. Now, if you're managing a $100 billion portfolio, you can't go sell enough call options and buy enough put options to do this. So you'd have to play the markets a lot differently than we're able to do, you know, from our phone app, managing, you know, maybe $500,000 to $1 million. So we definitely have some big advantages by being a small potato.
Thank you.
Thank you, Jason.
Yeah, any other questions out there?
The education's worthwhile. You're never right 100% of the time. Only my wife is, but.
Smart man.
No, you know what? We've been doing all right by, I'd rather be precautious and wrong than hopeful and right. So I guess that's kind of what happened last week, but.
Well, thank you.
Hey, my pleasure. Thank you, Oscar.
Have a great day, guys.
Any final questions out there?
Hey, I was looking as you were dropping some names like Dalio and the others earlier. I found the YouTube video I watched last Friday. Gary Schilling, he said that he shorted the market, the S&P 500, and encourages investors to do the same as global recession is coming. It's this exact type of thing, Jason, that makes me pull my money out of my 401k.
Mm-hmm.
I'm glad I'm not listening to it anymore.
Yeah. Oh man, there's a lot of doom and gloomers out there, and It's just important to know what everybody's bias is. Every single person I listen to, I try to know what's their bias. I like to listen to Peter Schiff, but I know he's only going to tout gold.
Yeah.
So, I like to listen to Gunlack and Dalio, but, their bias is they want to short the dollar and pitch bonds and scare you out of just something like the SPY. I like to listen to CNBC, but I know they're just cheerleaders no matter what. So as long as you know their bias, you can put together a better picture.
That is so true. Oh my gosh. Everything you just said, you better cut and paste that. That just frame that one. That is absolutely true.
Buffett's going to tell you to buy stocks no matter what. He won't ever budge from that. What's interesting, this is the first time I saw Buffett say he likes China. The last decade of following him, he was, he couldn't find.
Buffett also said he was an idiot for not buying Amazon. So.
Yeah. So.
Yeah.
Yeah.
Speaking of Amazon, do you ever look at the XLY as kind of like an alternative, since it has like 20 some odd % Amazon in it, since it's so much cheaper?
Oh, let's check that out. Oh, okay. Consumer discretionary.
Yeah, look at the percentage of how much is Amazon is in that thing versus the price versus what the price of Amazon is.
Yeah, so it's a good way to get a heavy.
Right, exposure. Mm-hmm.
Yep, there we go. 21%.
22.
And Home Depot, yeah.
Yeah.
That one's been very strong.
Yeah, because it's this time of the year I start looking at some of that stuff again because, depending on how our Christmas is going to go. Last year didn't work out so well because it was, last year. But normally it does.
Very good. All right, guys. Any last questions? Well, thank you once again for showing up. We had a bigger crowd than normal, and it was great to hear everyone's voices. We'll get our Thursday trade out tomorrow, so thanks again, and we'll get the replay out this evening in case anybody wants to rewatch it.
Thank you.
Thanks, Karen.
Thank you.
Thanks, Scott. Awesome.
Thank you.
Ernest. Everybody, thank you.